Hello and welcome to Fidelity Connect. I'm Glenn Davidson. Earnings season is underway and results so far have been stronger than expected, offering early signals that are being reflected already in market sentiment and performance. Today we'll take a broader look at what's shaping the outlook for US and global equities, including how innovation is driving efficiency, what AI could mean for jobs, and how shifting consumer dynamics, tariffs, and evolving fiscal and monetary policy are influencing the road ahead. Joining me is Chris Lee, Chief Investment Officer of the Equity Division based in Boston and Portfolio Manager on over $100 billion in assets across balanced, global, and advanced equity strategies. And just a reminder, today's webcast is available with live French audio interpretation. Chris, it's great to see you from steamy Boston today.
Great to be here. Thanks for having me, Glenn.
Chris, as said at the outset, you're CIO, you're on the multi-strategy division of Fidelity. Over $100 billion rolls up to you in assets. Could you describe more about what you do with the team, please?
Sure. In my role, I am a team leader on what we call team managed strategies. So these are, in many cases, co-managed strategies where we have sector experts investing in each of the various sectors within the market: technology, healthcare, consumer, and we roll that up into a parent portfolio. And really, what we're doing is we're harnessing a lot of our research ideas. These managers are embedded in research, and I'm working with them to assemble a cohesive portfolio that reflects our best ideas overall. So in addition, as a CIO, I do work with a number of diversified managers too. So I have the great fortune of touching many parts of our research organization and our investing organization, and trying to bring those best ideas into our portfolios.
So you're tied in with the US team, but also the international team. The amount of information flowing through you every day must be incredible.
Yeah, we have a great fortune here, as you know, at Fidelity, to have incredible access, great breadth of research, and are through that, and as well as our overall collaboration, able to stay on top of the key market trends that are driving the markets today.
And that's why you're here today, so we can talk about all that's been going on. And just a reminder to our viewers, if you have any questions, send them on through, and I'll get them on a monitor here and be sure to ask them. It's been a busy year. It's been a busy month. It's been a busy day. This week is going to be busy. There's so much happening in the market. Just geopolitically, it's incredible. Why don't we start, Chris, with a year-to-date overview? What's been going on in your mind?
Yeah, certainly a lot to talk about here. And if you just look point to point, for example, the S&P 500, it's up about 9% or so, from the beginning of the year until at the end of last week, let's call it. But within that, incredible amounts of volatility. We had a 20% drawdown from the early January timeframe into April, and a subsequent 30%-ish rally off of the bottom to get to that 9% point-to-point appreciation. Clearly, a lot of things that have driven the market sentiment. Number one, and we'll probably talk more about this, is just the AI narrative and some controversies that have arisen with respect to the overall AI trajectory, the need for computing capacity, and what that could mean for a lot of the key players within the AI value chain. That was one major driver in the front half of the year. And then, policy, tariffs, and U.S. tariffs in particular, being very much at the forefront in terms of driving markets, into the March-April timeframe, and then a subsequent sort of reinterpretation of what that means for the investing backdrop. So, yes, an incredible amount of volatility. You wouldn't know it just looking point to point, but many moving pieces beneath the surface.
In fact, so many moving pieces, we could turn this webcast into a 5-hour one, but we won't. We'll just keep it to a few key themes, which you've just touched on. Why don't we start with AI? I think back to January, DeepSeek. That was a big issue. That seems like years ago, but that was just January of this year. What's your take on what happened with DeepSeek? We don't hear as much about it now, but that caused some gyrations in the market as well, in particular because we built up last year on the AI theme, and then there was this volatility in January.
For sure. So one of the major market themes, and I think this is self-evident to many of us who have been involved in the markets over the past couple of years, is this AI transition. And I think it's fair to say this is going to be one of the more monumental platform shifts that we've seen, not too dissimilar to when we moved from desktop computing to mobile to the web, and now obviously in a new computing kind of paradigm with AI. And in more specifically, what's been driving the market leadership, if you will, has been driven by companies that are benefiting from AI compute. And this is not just on a first order basis. So these are companies like NVIDIA, Broadcom, et cetera, that supply the chips and the computing kind of nuts and bolts, but also in areas like utilities and industrials where we've learned about power constraints in order to power data centers. And within the industrials sector, there are companies that are involved with building data centers. So, there's been tremendous amount of enthusiasm around companies participating in that entire value chain. And that's been a real leadership area within the market over the past, couple of years. You mentioned DeepSeek, which really came to the forefront at the beginning of January. So this is actually a model that was developed in China, and to maybe just probably oversimplifying it, showed incredible performance and capability, but was ostensibly driven and enabled by and used computing power that was much less than what some of these more advanced models even in the U.S. required. And so that drew into question whether the compute, all this compute build out was going to be necessary. Were there efficiencies that were occurring that might, curtail perhaps this great demand that we're seeing among all these companies? And so as the market wrestled with that, a lot of these stocks, saw weakness as a result of this kind of new controversy that had arisen, and really questioned this very aggressive spending backdrop that we've been experiencing.
At the time, how did you, as CIO, deal with, and your team deal with, that volatility that came into the market in January? What resources can you utilize to help digest what's happening?
So I'd point to a couple of things. I mentioned at the outset, the breadth of research and our access at Fidelity, and the relationships that we've built over many years. One that I just point to is, we know the CEO of NVIDIA, Jensen Huang, quite well. On that day when the market was pulling back, we had the opportunity to speak with him and get some insights into what all this meant. What was DeepSeek? And what's interesting is we had researched this in the past. It wasn't unbeknownst to us, but it became very apparent to the market on a lagged basis. And so we did bring some knowledge to that conversation, and really were able to use that to help contextualize whether this was actually a paradigm shift with respect to computing needs or not. I'll give a second example. We are, and we selectively invest in private companies, and in particular are invested in one of the large leading language model developers that is, again, a company that is building out, computing capability. And they essentially gave us the insight that, hey, if people don't want NVIDIA GPUs, we'll buy them. So in other words, the innovations that were, and the questions that were being raised by this new DeepSeek model, in fact, reinforced the idea that, as we transition from training to inference, that computing demand was actually going to accelerate, not decelerate, in simple terms. And so in that moment of great uncertainty, we were starting to, and were able to kind of piece together and build our conviction in the context of, continued demand for AI compute infrastructure.
Oh, that's excellent. And you mentioned earlier about the peripheral businesses that really benefit from AI. One of them was energy and energy distribution. And I think I'm right in saying small modular reactors. Those were talked about a lot, certainly last year. And now even micro reactors that can get into all areas of the geography. Is that still a trend that you see? Yeah,
so there is in basic terms, there's a shortage of power. And there are companies that are out of the regulated realm that can price their power on a spot basis. So, their ability to kind of garner excess rents and react to the supply-demand imbalance is higher. And so, and then you overlay that with different forms of energy that are, perceived to be clean energy. And some of those utility names have been real leaders in the marketplace because they have those attributes. And so the theme of power as it relates to AI continues to be very powerful, and you see a lot of investment going on in that area.
Interesting. Do you see AI as a job eliminator, or do you see it as something that works along with people in order to build efficiency in their day-to-day and in corporate day-to-day?
Yeah, that's a really great question. I think it's still one that is up for a great debate as well. I think on the more skeptical side, you might say that there is, some efficiencies to be gained in certain tasks that, some customer service, for example, where, the types of things that they're doing and the functions that they serve may well be, adequately addressed through agentic AI. So some sort of automated fashion, if not even improved. On the flip side, and so I think there'll be some of that occurs. On the flip side, and this is the case with any innovation over the course of many, many years, it improves productivity. And what does improved productivity result in? Faster growth. So in other words, it frees up capacity, in fact, for folks to dedicate their efforts, ideas, creativity, energy into pursuing new ideas, which actually opens up, opportunities that we perhaps didn't even conceive of, and ultimately accelerates growth. So rather than in a static sense, just eliminating jobs, it can over time actually create more jobs. And I think that's the case that we've seen over the course of history. But in the short run, there can be some puts and takes with respect to, further efficiency gains, if you will, for existing functions. But again, ultimately backfilled by kind of new innovations as well.
Makes sense. I'd be remiss if I didn't make my next question about tariffs. We should talk about tariffs, your thoughts overall on where we stand and where, in particular, the United States stands today.
Sure. I think we've all been trying to follow along the headlines and the various, let's call them ebbs and flows in terms of the news flow with respect to tariffs. I think the market has taken a stance, and perhaps rightfully so, that a lot of the headline numbers that we saw initially were really a point of negotiation, and there are other sort of variables and factors that are feeding into that negotiation, which is happening in the public realm, and so that can drive volatility. But overall, I think the impact of tariffs, the market I think is being a little bit more is seeing through some of that uncertainty. I think there will be real economy impacts, but clearly much more diminished than what we had perhaps originally feared in April.
So the market is realizing this is a negotiation tactic. They're also seeing dates be pushed out further and further. So it's something like, as you said, it seems to be digested in the market. Interestingly, the EU seemed to have struck a deal of some sort yesterday or the day prior. France came out overnight and said, we're not so thrilled. Do you think that there will be other cracks throughout the EU?
I think it's hard to say, with respect to the EU or broadly with any specific country. I think there's still, and I would anticipate there's going to be, again, some ebbs and flows with respect to how the details ultimately, and where the details ultimately land. I think with respect to tariffs, I think China still remains one of the main focal points. And our relationship with, and our trade relationship with China. And not to say that other countries aren't important, but I think that remains a focal point. And I think again, in the context of the overall arc of where we started and where we land, there could be, dissident countries, if you will, with respect to reaching agreement. But generally speaking, we'll land in a space that was, less than feared.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connect's, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Interestingly, the president has talked through the media as a tariff on Japan, perhaps, or on the EU as being a cost to those markets and those companies. When, if I think back to my economics textbooks of many, many years ago, it's actually a cost potentially to the consumer, in this case, in the United States. Is it impacting earnings at this point? Are you seeing that already of U.S. companies?
What's interesting, and we've been kind of traversing, as you mentioned, the bulk of earnings season. We're sort of right in the midst of that. In the U.S., obviously, these companies, many of these companies are multinational, so we have a little bit of window on sort of the global impact. I think, what overall, I would say earnings have been and have come in better than expected, and I think part of that is the initial sort of sharing of the tariff burden. And again, I think this is still very early on. The next couple of quarters we'll get a better sense, but it just anecdotally in listening to the companies and how they're reacting to the tariff burden, really there's three sources in which that tariff gets distributed. It's the end consumer through the form of higher end prices, the supply, the company themselves, the business that's providing a particular product, and then their supply base. So three sources. And I think initially the concern was that the consumer would bear the burden of that. I saw some analysis that, roughly speaking, we thought the consumer would take 70% of that tariff burden, with the balance of that being, absorbed, by the suppliers and the producer. What I think has happened is that distribution's come out much more evenly. So in part, the consumer's bearing some of that, but also the producer in the form of, slight margin compression, and the suppliers as well downstream. And so I think that's moderated overall the fear of tariffs sort of, really being incredibly disruptive to the real economy. And in the meantime as well, you're seeing a lot of these companies very quickly alter their supply chains too, to adapt to the new environment. So it's another reminder that we don't live in a static world. And so, I think that has been a bit of the narrative around tariffs, and perhaps why the market has become more comfortable with that overhang.
I like your comment about us not being in a static world. Could you imagine the news every day if we did live in that? Is it fair to say that perhaps the larger capitalization companies are eating those tariffs? That's potentially impacting earnings. Smaller companies are needing to pass them through, and that'll really shape up in the form of inflation for the consumer, won't it? For the economy.
Yeah, I think, and that kind of gets back to the sharing of that tariff burden. So if in fact all the suppliers and the producers were going to pass all of the tariff burden on, you would see that in the form of goods inflation, ultimately borne by the consumer. And I think what you're finding is that producers are maybe a little less willing to pass all of that on. They're pushing some of that back to the suppliers. So that burden in proportion is actually lower than what you would have thought the consumer would bear. Mm-hmm. And so the inflation impact has been more modest. Now we've seen some indications, again, early on, of some modest inflation. What's interesting in the U.S., it's been offset by deflation on the services side. So the overall inflation picture is still one of relatively, contained inflation, overall. I think you asked about kind of large companies relative to small companies too. Ironically, large companies have a few more levers in terms of readjusting their supply chain to optimize around the different tariff levels. So you see, companies moving production from one high tariff region to another. They have more fungible capacity, whereas and necessarily maybe smaller companies that are more dependent on a particular area have less flexibility in the short run.
You mentioned inflation. That's a great transition to the next question, which really has to do with the Fed meeting tomorrow. What are your thoughts?
So, we've been monitoring, and as we just touched on, the inflation data and how that's been tracking. The economy itself is maybe, if you're, in the dovish camp, inconveniently robust. Earnings have been robust. Employment, picture remains quite solid. I'd say if you look at some of the market consensus of market forecasts, we've gone from expecting coming into the year roughly 4 cuts per year, now down to roughly 2 for the back half of the year. There's also some, and maybe this is more background around the potential politicization of the Fed. So a lot of things in the soup, if you will. But overall, I think the market view is that the Fed has, and this is true of the Fed, they've articulated a very data dependent approach. And I think a lot of market pundits would say the data suggests that they continue to wait and see. I think the Fed has also said the lagged effects of tariffs are still unknown. We talked a little bit about how that may transpire or transmit to the real economy, but it's still very early. And so you kind of put that together. And again, I think the market consensus is that, we'll stay put. And I think a lot of the reaction is going to come from the commentary and perhaps the sort of the voting contours of, do we get one dissident vote or two dissident votes, and how does that what does that indicate for the future? But for the very near term, it would seem that the Fed would be in a position to continue to wait and see how the data progresses.
It'll be very interesting in what sentiment we achieve tomorrow as well. Another question on earnings, just to go back to that. You've got the 14th floor above you. I don't know what floor you're on right now, but you've got the 14th floor above you. I know that. That's where all the company meetings are held. There won't be any this week because it's earnings season. But you and your team have the ability, just like any portfolio manager or analyst at Fidelity, to wander up there and involve yourself in all of the company meetings from publicly traded and private companies that come in to see Fidelity. Up to the point that you last were able to do that, what's the vibe you're, especially about the consumer? Like, what are you finding about the overall sentiment right now?
Yeah, so the 14th floor, just to kind of give people a visual, is almost like a large doctor's office, and we've got a large corporate lobby, and it's a fascinating backdrop where we have CEOs, CFOs, leading senior management folks coming in, kind of all milling around, and we have roughly 15 or 20 conference rooms where we kind of go off and meet with them. And it's a real repository for just, of corporate America. And so, what Glenn's describing is, this stream of companies that come in. And, I think most recently, the vibe has been one of cautious optimism. I think, the initial uncertainty as it pertains to tariffs has resolved itself. I think companies are feeling like they have a strategy, an approach to, not just combat kind of the new changes, but also position themselves to be flexible down the line. I think, in some ways we had some separation or divergence between hard data and soft data. You started to see that converge in terms of the soft data going from more pessimistic perhaps to more a hint of optimism. And so, I think the general vibe, as you had asked, is one of cautious optimism. What's interesting too is you're seeing more M&A pickup, and generally that is that's an activity that tends to happen when there is a hint more confidence in the economy, and just another sort of anecdotal thing that is worth noting.
Very interesting. Thank you for that. Love to ask you about meme stocks. As you said at the outside of this discussion, there's been a real pickup in volatility. Meme stocks would contribute to that. A lot of non-traditional asset classes that have seen the light of day as well for the last couple of years. Maybe a long shot, but is that a generational issue? Or is the catalyst generational?
I like to think it is more a proxy for risk appetite. And, I think when folks feel like there's opportunity to maybe make money on a short-term basis, perhaps you see some of these stocks kind of take on a life of their own. We didn't talk about Bitcoin, but maybe there's a sort of a distant relationship with, kind of the meme environment and Bitcoin. I think we can debate whether there's more of a fundamental context for Bitcoin. It's interesting to note that Bitcoin and gold have both been appreciating in concert, and perhaps there's some sort of macro underpinnings that are driving that. But to your question about meme stocks, and I think we can go back and see some of the behavior in COVID when there was more speculation in the market, and it's fair to say that some of that is back in today's environment.
Makes sense. It's going to be very interesting to continue to watch. Chris, do you have some quick comments on the U.S. versus non-U.S. investing right now?
Sure. So one of the interesting trends that has emerged here year to date is just the leadership shift, perhaps, from the U.S. market, let's say in the aggregate, S&P 500 as a proxy, up, as I said, about 9%. And some of the large international markets, I think the EFA index is up over 20%, emerging markets up about 20% or so. I think there's some fundamental reasons why that would seem substantiated. If you go back to the end of last year, the relative valuation gaps between some of the international markets and the U.S. had really widened. So the starting valuation for international markets was low. You had some major changes with respect to fiscal spending in the EU, for example, somewhat driven by defense, but other areas, and as well a weakening U.S. dollar. So the backdrop here, in many ways, in hindsight, again, would seem to favor some international markets, and in fact, that's what you've seen play out here, at least year to date. And so, to the extent some of those trends remain in place, I think there's some rationale to considering diversification in the context of international relative to the U.S.
Very good overview. Thank you for that. Fidelity is made up of technical, fundamental, and quantitative research. The last time you and I spoke was in January when a new fund was launched. It was you and Gil Haddad, and we talked about the Advanced U.S. Equity Fund that had just come out. And my recollection of that is it's fundamentally driven, and there's a quantitative overlay. And you likened it to a GPS, if you will. Instead of me just looking at a map, I'm going to have assistance on how to get me where I need to go the most efficient and practical way. Could you talk more about that fund? It's not a year yet, but it's on the halfway mark, and I thought it was a fascinating structure, the Advanced U.S. Equity Fund.
Yeah, so this is an exciting new product that we've been able to bring to market, which really marries our sort of long-standing, if you will, fundamental research that we have 125 analysts globally that are investigating companies and then producing recommendations and signals in terms of buy, sell, price targets, forecasted earnings growth, et cetera. So there's a treasure trove of information that we can mine. And with this product, we've married that data with our capabilities from our quantitative research team. And they look at those that data. We've researched it to see what indicators perhaps provide the most forward and best forward-looking return expectations, if you will, and how to assemble that in the most constructive and risk-managed way. And so this portfolio brings all those capabilities together. And so what we're doing is we're harnessing and harvesting, if you will, the best ideas from our research team, but leveraging our capabilities on the quantitative side to assemble that in a very unique fashion. And to your point about the GPS, that's really the sort of the neat part about this strategy, which is that it takes a lot of great information and assembles it in a very unique way with the goal of outperforming the market.
Great, thank you for that. We just have a minute or so left. I wonder if you could give us not a prediction, but some thoughts as we look at the second half of 2025, Chris.
Sure. I think we've talked about some of these themes that have certainly been very prevalent in the front half. I fully anticipate that they'll remain front of mind as we traverse into the second half of the year. I think, a lot of the one thing we didn't touch on is some of the geopolitical events that have, occurred and whether that becomes more of a issue that coming to the forefront. And I think one of the prevailing, kind of questions is just around kind of the fiscal position in the U.S. and even broadly, and what that means for monetary and fiscal policy, globally, interest rates, et cetera. So I think the backdrop and the context for our investing environment does run the risk of really evolving here as we traverse into the second half. Ultimately, it's will come down to earnings and, whether the companies and the economy can deliver the expectations, the earnings that what we're hoping for. The S&P, within the S&P 500, I think the earnings growth projection is roughly 7% ish for this year, and accelerating to kind of mid to low teens in 2026. So that's a reasonably high bar, and I think monitoring the reasonableness of that expectation as we traverse the second half of the year will be very informative in terms of how markets will perform.
Chris, as I said at the beginning, there's hours that we could be talking about of material, but we won't do that because we'll get unplugged if we do. But thank you so much, Chris Lee, for joining us today. It was very interesting to get your overview.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.